Now let's talk about FICO and its 5-factor modeling system. This is what determines how they calculate your score. The first one is credit history. This one's going to account for 35% of your score. So this is a huge deal. This is the biggest factor in determining your credit score. What they look at is, do you make your payments on time? That's it. This is the single most important thing for determining your credit score. The second most important factor is credit utilization. What credit utilization is it takes all your revolving credit, your limits, and then compares that to how much you're actually borrowing. So if you have a limit of $100,000, but you're only borrowing $10,000, that's a 10% credit utilization. Now, it looks at two parts. One, your total revolving credit is factored. The other one is each individual line of credit. So each credit card, what's your utilization there, and then all your credit cards and what's the total utilization for all of them. So those both matter. A good way to optimize is to keep it under 10%. So 1 to 10% is optimal. 30% is your general rule of thumb, and beyond that you start to have negative impacts. So keep your credit utilization low. The third most important factor in your FICO score is credit history. This one accounts for 15% of your score. What it looks at is the length of time of your average revolving credit. So if you have one credit card and you had 10 years, that would be a 10-year credit history. However, if you opened up a new credit card today, it would average the two of those out and you would have a 5-year credit history. So when opening up new lines of credit, be strategic about it. It doesn't mean it's a bad thing, just have a plan. Okay, the fourth most important factor in your credit score is inquiries. This accounts for 10% of your score. An inquiry is when you go and apply for a new loan or have your credit checked, this is an inquiry. This will temporarily drop your score. It's not long lasting, but it does affect your score. All right, now the fifth factor in your FICO score is your credit mix. This one also accounts for 10% of your score. What FICO is looking for is the mix of your installment loans versus your revolving credit. Remember, your revolving credit is like your HELOCs or your credit cards. You have a limit to which you can borrow. You can pay it back and that opens up your limit again. Then you can borrow it and you can pay it down. That's revolving credit. Installment credit is where you borrow and as you pay it down, it does not increase your limit. You cannot reborrow that money. So credit mix looks at a balance of your revolving and your installment loans.